Is typical retirement advice good advice? That's what we're going to talk about today. So if you're thinking about retiring, or your parents or family members, the typical advice, there's a few conventional wisdom that you get from the internet or from friends or from financial planners or the bank. And what we're going to do today is we're going to take a look at them and measure them out and see, have they actually worked in history? So I'm the unconventional wisdom guy. I'm the guy that does the math and actually looks at strategies to see if they actually worked. And then we're also going to talk about what are the new rules. Like if these things don't work, what should we be doing today? So first, let me just share part of my screen here so you can see some of my what I'm looking at. So is typical retirement advice good advice? So first of all, here is what most seniors, the advice they usually get. First one is the 4% rule. That's talked about a lot. Now, if you're wondering what it is, so the 4% rule is you can safely withdraw 4% of your investments and increase it by inflation for the rest of your life. So, for example, $40,000 per year from a $1 million portfolio. And usually we're talking about a 30-year period is what we look at. So, right, you've got a $1 million portfolio, take $40,000 a year, increase it by inflation. So, does that work? Second one is the age rule. So this is basically you take 100 minus your age, and that's how much you should have in stocks. So, okay, stocks versus bonds. So stocks are investing in companies, bonds is fixed income. So it's your age is the percentage of bonds you should have. For example, age 70, you should have 70% bonds, 30% stocks. Third one is called sequence of returns. So this is based on, the general conventional wisdom is you're old, so you should invest conservatively, right? And it's invested conservatively because you can't afford to take a loss. So you can run out of money because of the sequence of returns, which means, let's say you have a big decline early in your retirement, you never recover. So you can't recover from an investment loss early in retirement. So is that true? Number 4 is don't touch your principal, just try to live off the interest. And the cash buffer, keep cash equal to 2 years income to draw on when your investments are down. So these are the things we're going to look at. Let's see if they have actually worked in history. So first, a little sneak preview. I'm going to tell you the results based on history are none of these rules have been reliable in history, none of them. So let's take a look at them one by one. First one is the 4% rule. Okay, so we're taking 4% out, and we're out of your investments, and you're investing it. So the first question is, it depends a lot on how you invest it. So what I looked at is different withdrawal rates, and I also looked at different portfolios. So let's say this is 100% stocks, 0 bonds. Okay, 50-50 would be, or a 60-40. This would be if you have a balanced fund or income fund or something, and or maybe an all-in-one. And this one is 0. It's no stocks, 100% bonds. So did it actually work? So the 4% rule is this blue line, and notice it has been actually pretty reliable in history. If you have 70% or more in stocks and not in bonds. So now that's surprising, actually, that you think, well, 70% or more in stocks is generally thought of as fairly aggressive. And, if you're older, you should invest more conservatively. But you know what, if you see these lines, what happens is the more you put in bonds, the less likely it works. So this is 97% of the time it worked. So 97% of the time, you're able to take 4% out. You have a $1 million portfolio, take 40,000 a year, increase it for inflation, and it lasted at least 30 years. All right. So, but if you were if you're all in bonds, it only worked 47% of the time, which is bad. So generally, I suggest it's good to have 97 or a very high rate, because even 95% means you have a 1 in 20% chance. 1 in 20 chance of running out of money. So 95% sounds good, but maybe it's not that. So this is what so the rule basically from it is it has worked with stocks, but not with bonds. Now, you may find that surprising, but this is why that is. So this is the actual history of stocks versus bonds. Of course, everybody tells you stocks are risky, bonds are safe, right? I'm sure you've all heard that. But so this is based on 200 years of data. The standard deviation is a statistical measure of risk. So basically uncertainty of return. And so you can see, these are all after inflation too. So you can see over 1 year, 2 year, 3 year, 5 year, stocks, it's a picture of risk. Stocks are riskier than bonds and cash. Okay, the investment industry, the official definition of risk of investments is a 3-year standard deviation for some reason, and therefore stocks are riskier than bonds. But here's the surprising thing: like if you're in for 20 years or 30 years, most retirements are 30 years or more, and when you're in for 30 years, stocks are actually more predictable. We can see this lower standard deviation. We can more accurately predict where the stock market will be 30 years from now than bonds, after inflation. So that may be surprising, but that's kind of the fact of it. And that's why stocks do better with the 4% rule. So starting with the 4% rule, it's pretty safe with stocks, 97% success rate, but not with bonds, 47% success rate. That's horrible. So also 100% success rate with effective management of the withdrawal rate. So there is a bunch of, we actually looked through a bunch of the management strategies. How do you manage how you take out? And there's a few that have been, there have been articles published about them, the Guyton-Klinger strategy and the Hebler autopilot. But, we've come up with our own for our clients just based on experience on what actually has worked. And we found what works, like 2000 through the 2008 crash and the recent markets. And we've learned a method that actually works. And, with that, you can have 100% success rate with a high portion in stocks. So that's what you can do about the 4% rule. But the standard one doesn't work for very conservative investors. So now age rule. Now, so it's you have your age is what you have in bonds. So, the average retirement age is 62 here in Canada. And if you take a couple, take whichever one lives the longest, half of couples, one makes it to 94. Okay. So an average retirement is 32 years. That's like 50% of Canadians get a 32-year retirement. That's one of the people in the couple. So your average age in retirement is 78, average of those two. So that means with the age rule, you end up with 78%, so basically 80% in bonds. Okay. Now, if you remember the chart from we looked before, with the 4% rule, 80% in bonds, there was only a 69% success rate. So it's a 31% failure rate. So here's the chart. So here it is. So this is the age rule. It's way down over here. Okay. So bottom line is, if you're using the age rule, it conflicts with the 4% rule. You can't use them both. So if you're using the age rule, you're just investing too conservatively, and you're too much in bonds, which are not that reliable over the long term. So you need to restrict your withdrawals to 3%. Okay, that's out of a million portfolio, you take 30,000 instead of 40. But it's because you invest so conservatively, you need to do that. So now, next one is sequence of returns. And this is actually a really common one. I think you'll find that even a lot of very knowledgeable financial people talk about sequence of returns. And, it's a big issue for short-term and medium-term investors. But, this is 150 years of data, 25-year returns. And you notice it's always done well over 25-year periods. Retirement, we're talking about a 30-year period. So you know what? The truth is that for the stock market, sequence of returns is actually not a thing if you are truly a long-term investor. It means you have to stay invested for the whole period of time, but it's not actually a thing. So let's look at what's actually happened. So this is 150 years of data. Okay, so each line is a 30-year line, and it shows what happens. So you start with $1 million, and you take out 40,000 a year. This is based on the 4% rule, and you adjust it by inflation every year. So what actually happened? And this assumes you stay 100% equities all the way through. And you'll notice that most of the time you did pretty well. In fact, on average, at the end of your life, 30 years later, you have about 4 million. So you could actually increase your income partway through retirement because it's grown so much. Okay. However, let's focus on, the issue here is the small number of times where it failed. So remember, stocks, 97% success rate. So let's talk about that 3%. So what you see, this is, we start with 1 million and we go down to 0 here. So when did it go to 0? So you see there was 1 here where it went to 0. And there were 5 more over here in the late 90s, which is, it's an odd time because this is during the tech bubble where the stock market was gaining, 25% a year for 5 years in a row. That's when you ran out. Why did they run out? So this one here, it's just the one time it happened. And this is if you retire January 1st, 1929, just before the big crash, fell 83% over 4 years, and then took 4 more years to bounce back. So that was one case where it was based on a stock market crash. Now these 5 here are all based on high inflation. So this is the reason we ran out here, is because you retired in the late 60s, and then we had high inflation through the 70s and 80s, and your income to keep up inflation has grown up a lot, and then it just can't keep up and it runs out. So once in history, we've had it's been the sequence of returns error. Only once has there a market crash made you run out. 5 times it's based on inflation. So inflation is actually the real scare. So let's see, this is what happened with bonds. So bonds are just like a total disaster. So how often did it go to 0? So interestingly, if you retired between 1880 and 1980, there's 100 years, you ran out of money with the 4% rule and 100% bonds almost 100% of the time. Now, there was a bit of success if you retired way back in the 1870s, or if you've retired here, like after 1980, and looking at what it's going to look like going forward, what it's going to look like is people who retired up till about 2005 to 2010, 100% bonds is probably going to work. We haven't finished that 30 years yet. But anyone who retired after 2010 and also going over the next probably couple decades, it's probably not going to work again. And I'll explain why that is in a minute. So now the clients here, some of them, there were some periods where interest rates were rising, which makes bonds go down. But almost all of these failures of bonds are because of inflation, because bonds make a pretty low general rate of return most of the time, and it's very often it's close to or less than inflation, doesn't keep up, and so that's how you can run out of money. So, all right, so sequence of returns, it's an issue for short-term and medium-term investors. A sequence of returns is not a thing for a truly long-term equity investors. The stock market has been reliable through history over 25-year periods. And, so the real issue is inflation. So only once has there been a problem based on a market crash, where a sequence of returns would have been an issue. And, that was back when the 1 year, 1929, if you retired in 28 or 1930, you'd be fine, just that 1 year. And that was, the central banks back then did not know how to manage the economy, and they made it much worse. And I think that's the reason why it happened then. And that's why I'm not really worried about it happening now based on a market crash. However, 5 times it's been based on inflation. So if inflation is high, like now it is fairly high, and there's a lot of speculation that it'll come back down to the 2 or 3% range. I think personally it'll probably take, maybe 5 years to do that. So, but if it eventually comes down, then you're fine. But if inflation stays high, that's the big risk on the whole sequence of, that's the big risk, not sequence of returns. Next thinking is don't touch your principal. Now this is, back on, these are not really investors. I think this rule more applies to people who are savers, not investors. And the problem with it is the thinking, it's the wrong mindset, okay? Because you have investments that grow. And if you don't think about principal, just think about the total amount you have invested. Especially if you're investing in the stock market, it goes up and down. There isn't really such a thing as principal. So principal generally applies to fixed income. You're buying GICs or something, or bonds, or something with fixed income. But like the thing is, we're retiring for 30 years with inflation at 3%, which has been just a bit around with the long-term average. Cost of living 30 years from now will be 2.5 times higher than today. So you need a rising income, not a fixed income. And that's the reason why this whole don't touch your principal thing actually worked. And actually, so we've written, well over 1,000 financial plans for people, and comprehensive plans. And this is what you'll find surprising, is most of the growth, so most of the retirement income for that 30-year retirement comes from growth after you retire. And that's why it's important to stay effectively invested all the way through retirement. It's a 30-year, it's a long period. So if you have a balanced portfolio, say averaging 5%, at a typical couple, average kind of income and average retirement income, 60% of the retirement income roughly is from growth after retirement. And if you have an equity portfolio, you generally have a higher retirement income this way, and 80% of your retirement income is based on growth after retirement. So it's not just the number you need to have to retire. Most of the growth, most of your retirement lifestyle is based on that growth afterwards. So this don't touch your principal is not really, you need to invest to get, growth continuing. Next one is cash buffer. Now this one actually seems to make a lot of sense, right? So you have 2 years cash, and you know what? We know that the market has crashes now and then, and and if you're a long-term investor, you want to leave the money invested so that it recovers. And we know from history that stock markets always recover. They've always recovered with sometimes. You just leave it. So you got some cash. The market goes down. You don't you don't touch your stock market investments. You just live off the cash for a year or two until it recovers. Okay, and then after it's gone up again, then you replenish your cash buffer. So now that allows your investments to keep going. It sounds like it's common sense, like it should work, right? However, I tested it, and guess what? It did not work at all. In fact, looking at global markets, U.S. markets, and even in the UK, I was unable to find ever even a single case where a cash buffer was a benefit. So this is again, so based on no cash, 1 year's cash. The question is, if you're gonna have cash, how much do you have? 1 year, 2 year, 3 year, 4 year, 5 year? And then based on a withdrawal rate. So again, let's say you're doing the 4% withdrawal here. It's 96% success rate with no cash, 95 with 1 year cash, and 96 again with 2 years cash, and then back to 95. So it was really no benefit. Like the highest here has always been with no cash. 1 year's cash doesn't hurt you that much. But the real issue here is the money in cash is getting a much lower return than your overall investments, and that drags you down. So there are times where that can mean you run out of money. Your money doesn't last for the 30 years because your rate of return is too low because you get this money sitting in cash. Okay, and over a 30-year return, that cash drag is more significant. That's the main factor in this, is the drag on your return from having all this cash. That's a more significant factor than the benefit of keeping your equities and your investments invested during a market crash. So, all right, so the cash buffer, safest option is zero cash. That is actually the safest. That gives you the most reliable retirement income. So I have not found even one incident where a cash buffer was safer than zero cash. And that's looking at all the different markets. So return drag from cash is bigger than any savings from avoiding selling. All right, so now we saw those rules and they didn't work. Okay, none of them were completely reliable. Let's talk about new retirement rules of thumb. So this is based on history. What has actually worked and what should we do instead? So here's the lessons about it. So first of all, surprisingly, having equities like stock market is the safest thing to do. You're investing in companies that grow over time, and they're actually more reliable over the long term. So don't feel that you should invest more conservatively just because you're retired. That's what people say, right? You're old, therefore you should invest conservatively. However, you got a 30-year retirement in front of you, so that's the problem. So don't feel that you should. Now you might choose to. You still have to be within your risk level, but don't feel that this is the thing that you should do. So retirement is 30 plus years. So consider keeping the same allocation you had before retiring. So most of our clients, that's what they actually do. They've gotten comfortable with a certain risk level and they just keep it going after retirement. And it's at the then they're already used to that. And rather than getting more conservative, it's more effective to stay at a more growth level that you're comfortable with. So equities are also taxed at a much lower rates than bonds and GIC. So it's that's another benefit of it. So here's number 2 is, this 4% rule is pretty common. So here is the rule that actually worked. I looked at what is the actual rule. And the problem is you actually need a different rule based on how you invest. So the rule that actually works is a 2.5% rule plus 0.2 for every 10% in stocks. So now this is not very catchy. I've been trying to think of a little jingle, or how do I say this in a way that it's not cumbersome. I'm just calling it for now the Rempel rule or something, but it's the, so 2.5%. So for example, let's say you have 50-50, right? So 2.5% plus 50 is 5, 10% times 5 times the 0.2 is an extra 1. So if you have a 50-50 portfolio, half stocks, half bonds, then 3.5% is fine, right? If you're 100%, if you're 70% or more in stocks, then 4% is fine. And if 100% in bonds, then stick to 2.5% withdrawal. Okay, so that means instead of taking 40,000 out of your million portfolio, you're taking 25,000. So it's quite a bit lower income. But if you're that conservative, that's what you can support. So instead of withdrawing 4% of your retirement assets, use the formula if you have less than 70% stocks. Use this formula. And also, fixed income is lower income. Okay, it's if you feel safer, you just can't tolerate the fluctuation of equities, or you just feel you need to be in fixed income. That's fine if that's your choice. However, it is lower income. You should expect to have less income throughout your entire retirement. The more conservatively you invest, the lower your retirement income should be. Number 3, the age rule works with the 3% rule. Does not work with a 4% rule, but with 3% you're fine. Okay, that's because it's on average 80% bonds through a retirement. There's nothing wrong with investing conservatively with the age rule, but then reduce your retirement income to withdraw only 3% of your investments each year. Next one is be smart about your risk tolerance. So this is actually the big thing. So the big problem with the conventional wisdom about retirees is conventional wisdom is you're old, you have to invest conservatively, but conservatively means lower income and actually less reliable income, so and more tax. So that's all the problem with it. So, but if it's, if you have more in stocks, it's actually more reliable, but you have to be able to stick with it. You have to have the risk tolerance for it. You still need to invest within your risk tolerance. But let's be smart about it. So invest with the highest amount in stocks that is in with your risk tolerance. So I would, try to stretch it. If you could be 100% in stocks, that's great. That is, and you could, but if you can truly stay with it, which means when the market, falls 30%, you still have to stick through it. And just keep taking your regular retirement income and, wait for it to come back, and it does come back. So that's the best way to do it, the most effective way that gives you the highest retirement income. But you, knowing yourself, are you actually able to do that? So the more conservatively you invest, the more likely you'll run out of money. And that's at any withdrawal rate, 4%, 5, 4, 3. Get educated on stock and bond market history so you have an accurate picture of risks and returns. So I find a lot of people are conservative investors because they're not very knowledgeable about investing. And they hear fears about market crash, but they're not really knowledgeable, and that's why they fear it. So, risk tolerance is a skill you can learn. Like I learned, I used to be scared of flying. I used to be scared of heights, but I got used to it. I've flown a lot. Now when there's turbulence, I'm not terrified anymore because I know it's just going to be fine. Just wait a little bit, right? So used to be scared of heights, but I have a condo up that's up high. Now I can look down and not be scared anymore. It's a skill that you can learn. And the volatility of investments is the same thing. Once you've ridden through it a couple of times, you realize what comes back, that you don't worry about it and you can learn it. So now, first of all, what is risk tolerance? This is be clear, because if you go to most advisors, they pull out these surveys, a little questionnaire, and you answer it, and that's what your risk tolerance is. But what does it really mean? Is that really are those questionnaires really effective? And in the end, let's make it simple. Risk tolerance is the ability to do nothing when your investments go down. So, if investments fall 30%, people say, oh my God, you need to stop the bleeding. I need to sell them or switch to something more conservatively until the market stabilizes. But when it stabilizes, it's going to be 30 or 40% higher than where you are, right? So when the market has declined, the most important thing is that you be there for the recovery. You wrote it down, make sure you ride it up. And the only way to do that is to stay invested. So, sometimes it's hard thing to do, like a human gut will always tell you the wrong thing, but, it goes down. Really the secret to success is do nothing, have good quality investments that you're confident will do well over time. When they go down, just stick with them, keep taking your retirement income. But that's the definition of risk tolerance. So, and the way you look at it is, if the market, how far could the market fall? And you wouldn't be able to do nothing. You'd just be compelled to, you'd be too terrified. You couldn't sleep, and you'd have to do something. So what, 10, 20, 30, 40, how far could it fall? And then choose an investment portfolio that shouldn't fall more than that. That's so. And the stock market does have periods of time where it falls. Like 20% declines happen generally every couple of years. 30% usually I don't know, once or twice a decade. 40% is usually most of the time only once every several decades. But these kind of declines happen. So 40 to 50. So that's a normal range of them. But 88% of all declines, the market bounces back within 1 or 2 years, and it's always recovered within just a few more years. So if you just do nothing and stick with it, it actually is fine. So now let's take a look at. I just want to I mentioned on risk tolerance, get educated on stock and bond market. So this is 200 years of actual history. These numbers are all after inflation. Just $1 in 1800 would become 1.6 million after inflation, after 220 years. So the return for stocks has averaged 6 point. Let's say 7%. Real means after inflation. So let's just say 7% after inflation is the long-term return of stocks. But notice how close it has been to this trend line all the way along. Now, you don't experience it that way because, this is decades where you're ahead and behind. It's an exponential graph. So you don't experience it that way. But I show this to you because people sometimes ask me, what happens if, stocks stop being a good investment? Let's say we have a bad government or climate change or whatever, some other problem, and stocks stop becoming a good investment. But, stocks we're investing in companies, they have a management, and whatever the hell happens, the management adjusts their operations. They can lay people off. They can buy another company. They can get a new product. They can restructure. They can do all kinds of things. They're going to find a way to get their profits back up, and they adjust. And that's why stocks are pretty reliable over time. So this is bonds. So you'll see if you did a trend line through this, wherever you drew that line, you'd find that bonds aren't that close to the trend line as stocks. And that's why, remember, the standard deviation of bonds is higher for 30-year periods, and that's why. And the big thing is we had, this is the bond collapse. So interest rates, the last time they were this low was like 1950. And they went from 1% to 20% in 1982. And from 82 till 2020, they basically came down every year. And so if interest rates go up, bonds go down in value. okay? And if interest rates go down, bonds go up in value. So we had a 40-year return where bonds lost money basically all the time. And 40 years later, you were down 50% from where you started. So after inflation. But now the last 40 years, bonds have actually done pretty well, but that's because interest rates have come down pretty well every year. Well, now 2020, they bottomed. Now they've started to rise. And you know what? We're not going to be able to count this period of time. Basically, the returns were pretty good on bonds. And that's all, your investment advisor will only show you the last 40 years. And, stock bonds look reasonably good. But it's a period of time where essentially every year interest rates came down. So, and which, is something we can't count on again in our life. So, but notice the big important about it is how reliable stocks are over the long term. Okay. Now, but they do fall. And this is, I was talking about the declines. So this is, Canadian market. This is an actual decline. So a bear market is defined as a decline of over 20%. So on this chart is 15%, but it basically shows anytime we had a decline of 15% or more. And then from the bottom, how far did it go till the next decline? That's called the bull market. So we had a bear market of 26%, then up 85, then down 17, up 81. And, on average, the market is up 130%, more than doubles over 4.5 years. And then it's down 20% over 9 months. And, these down periods, almost all of them are less than a year, and then we're back into the next bull market, and it's much bigger and lasts much longer. And when you're down 30%, you will say, "Wow, I need if you're gone from 100 to 70, right? So you need 30 on you only got 70 left. You need about a 40% return to get back up or close to it, right? So, however, that's what the market has done reliably through history. So, but these declines are not insignificant. So that's what risk tolerance is. You can expect there to be declines of 20 or 30 or occasionally 40% that are going to happen on your investments, but it will be okay if you just stay with it. If you have good quality, diversified equities, and it'll be okay over time. And this is the same data on a continuous graph. And you'll notice if you take any two lines, these are decades here, right? 20 years apart, it always rises. So here again, the bear markets are the yellow, the bull markets are the gray. And if you just stay invested over the long term, it's been reliable. You can see that it works this way. So now, so the new rule, another new rules of thumb. The next rule. So that was the one all about. So what was that one about? Number 4. We were talking about the risk tolerance. Yep. Now. Number 5, inflation. And so inflation is actually huge. And it's actually important thing is, a lot of people talk about sequence of returns. I would suggest to you, if you're an equity investor, forget that. Focus on inflation. That's the real worry. Remember, that's the one that has actually caused stocks to run out of money. It's caused the 4% rule to fail 5 times in history and could again. Sequence of returns is only once, and then it's when the Bank of Canada basically messed it up. So inflation typically makes the cost of living 2.5 times higher during retirement. So in this period of higher retirement, higher inflation, that is the big issue. So that's something to focus on. If inflation is high, then we need to look at should you reduce your retirement income a little bit, or you got to allow for it. That's the real risk. Rising income, not a fixed income. And, inflation kills bonds. It really does. Like a lot of the time, bonds actually make less than inflation. Like just a couple of months ago, a 30-year bond in Canada had a yield to maturity over 30 years of 1.5%. And yet inflation long-term is averaged 2 to 3, and it's been about 7 right now. So you realize, over 30 years, you're not even going to keep up with inflation. And also inflation is generally, whenever there's higher inflation, you almost always have higher interest rates, and rising rates also kill bonds. So inflation kills bonds, but for the most part, it doesn't kill stocks. It might short term, but again, stocks adjust, right? If it's higher inflation, then companies raise their prices by inflation, and you can generally kind of make up for it. The next new rule is it's safer not to hold cash. Okay, so holding cash does not protect you and may increase your risk of running out of money. So remember, I've not been able to find even a single time in history where holding cash actually stopped you from running out of money. You actually was better than having no cash. So, and it's a big drag on your returns over time to have a bunch of money in cash. So it almost definitely means you die with quite a bit less in your estate if you have all this cash. So it's like some people need that because when the market goes down, having some cash and living off it, it gives them something to do, and that helps them stay invested. So if holding cash is your risk tolerance method, then actually maybe like if it allows you to have a higher amount of equities otherwise, then maybe it's worthwhile. But it's the benefits of cash are only emotional. They are not actual, in math and return numbers and benefit. No actual benefit there. Last one is you can have all three: higher income, lower risk, and low risk of running out of money and less tax by having a high equity allocation and managing it effectively. So the highest equity allocation you can tolerate is the most effective way to do it, to retire and have a reliable income with the lowest risk of running out of money. And you can have a higher reliable income if you can manage your income effectively or are working with a financial planner who knows how to do it. So basically you can have 100%, based on history, we would have had 100% reliable income with the 4% rule if you can manage that income, if you manage your withdrawals. So if things get kind of out of whack because the market goes down too much or something like that, then you just take a little bit less. We've developed our own method to do that, but that's how you can have a completely reliable income, and also it's a much higher income based on that. So bottom line, success in a long-term plan is you need a financial plan. So it's important to actually look at your retirement. What is the retirement you want? What are the things you want to do? What do you really want to spend? Let's document this plan. And if you're saving up for retirement, you got to look at what's the optimal way. How do you get there? What's the most effective way to get there? An interactive plan allows you to actually look at many possible life scenarios and see the effect of it. Like, what if I travel a bit more? Can I afford to do that? Or what if I invested a bit differently? What if I do this? So an interactive plan with our financial planning software, we can actually, in a few seconds, if you say, what if I did this or what if I did that, we can show you all those effects of it. So you can come up with something that is really, that works and is also something that you are happy with in your life. So having a financial plan is one of the really keys to having a solid retirement, and having an equity focus, like as much as you can in stocks, and really try to avoid bonds. Risk tolerance is a learned skill, and if you think long term, then you can learn it. It's because over the long term, it's all very different. All right, so my name is Ed Rempel. I'm the Unconventional Wisdom Guy. It's insights from experience on building financial security. And this is my blog. All my services are there on the services tab. You can contact us for a free consultation by hitting the contact there. Okay. And yes, and don't forget to, if you want to see all of my new videos and articles, the way to do it is go to my blog and just sign up for it. We don't market to you in any way or sell it in any way. All that means is whenever I have a new video or a new blog, you get it emailed to you. And also, if you subscribe to the YouTube channel, then you'll right away see all of my new videos when I put them out. So, all right. Last thing I want to show you is here is a testimonial. So value of a financial plan. So this is from an actual client. Just want to read this. So when we first met Ed Rempel, we were only 4 years from retirement and quite unsure of what to do. With Ed's knowledge and vision, he has shown how his plan can generate 15 to 20,000 of additional income per year throughout our retirement years. And that, in short, is the difference between a penny pinching golden years or the freedom to finance all the plans we already had made, but for which we didn't really know if the money would be there. So that's the value of a financial plan. And that's why following the new rules of retirement rather than the old fashioned conventional wisdom that doesn't work is the effective way to go. All right. So thanks a lot for listening. And don't forget to subscribe to the YouTube and to my blog. Thank you.